We were talking so much about the fiscal policies of the UK, but ultimately when it comes to the gilts market and potentially the pound as well, is the ball really in the US's court?
I think that there are two genuine drivers here in the UK. Normally you can identify that it's all about the macro or it's all about the domestic issues. I think UK has two very real drivers. I think there's very genuine concern about the UK's twin deficits and what's going to happen over the next year and the poor growth outlook. And that is exacerbated by what's happened in the macro level and at the uncertainty coming out of the US, both in terms of what might happen on the inflation side because of tariffs and of the disruption to global trade from tariffs. Now, on that tariff point, I am getting more optimistic by the kind of minute because I think the whole world is getting really, really caught up on these tweets and threats that we're getting out of the new US president, despite the fact that this seems to be the exact same playbook that we had 8 years ago. And things took a long while to get delivered. It does not mean we're not going to get any tariffs, but they're going to come through much later than originally planned. They're not going to be as aggressive, at least at the moment. We already know that the earliest we're going to get something is 1st of February. And I can't think anyone seriously believes we're going to get 25% tariffs on Canada and Mexico on the 1st of February. So most likely we've got a good few weeks window. And each of those tweets and threats will have diminishing marginal impact. So I actually think it's a good setup because we have people scared of the market because of all those tweets and tariff threats. And they're going to slowly be forced in over the coming weeks, essentially climbing that wall of worry. It's going to squeeze people into the market. So from a macro tariff point of view, I'm getting increasingly optimistic. Now, there are other drivers out there, I know.
Yeah. There is a growth story as well. Certainly the Trump administration is already pushing the deregulation story, the AI story, plenty of other stories as well to drive the economy forward. Is there a cost to that? Should we be thinking less about rate cuts in that kind of environment? How finely balanced is the rate cut, rate hike debate, given all of that?
I think it's extremely finely balanced. I'm in the camp that it's completely rational to consider that the next move from the Fed might indeed be a hike. I just think you can't have much certainty out there. I agree that the disinflation path worked out much better than I anticipated last year. It's gone pretty well. But I think that ultimately, I don't see why the Fed would be cutting rates again unless we see a hit to growth. Now, we could get a hit to growth if we do get sudden aggressive tariffs. That is absolutely possible. I'm not ruling out that we still may get an aggressive rate cutting cycle later on this year. But I think that for now, the Fed doesn't really have a clue what the next move is because at the moment, everything we're getting is pro-growth and it's positive for inflation in terms of higher inflation, which means it looks, at the moment, we're going to increasingly kind of want to squeeze out some of those rate cuts that are still kind of, the market is still kind of base case expecting. But then if we suddenly in the second or third quarter get aggressive tariffs and we get suddenly growth derailment, well, absolutely rate cuts come back in the margin. So it's extremely finely balanced. And if anything, for the moment, I think there's a little bit of upward pressure on yields in the short term in line with that risk on sentiment.